Is Australia really going to experience the worst housing correction on record, and we're going to lose all those gains that property markets have achieved over the last couple of years? Well, that's what the media would like you to believe. But this week, Dr. Andrew Wilson and I share with you some of the latest data that gives us an indication of what's really likely to be ahead for our property markets. So if you want to keep up to date with what's happening in housing, please subscribe to this YouTube channel and click the little bell icon so we can update you each time a new show comes out. Australia must brace for the worst housing correction on record as rising interest rates and recession fears strangle the property markets. Well, that's the latest warning from the big banks, which are now predicting that most of the gains made during the recent property boom are going to be erased over the next 2 years. Now, there's no doubt that we're in the adjustment phase of the property cycle, where values, particularly in Sydney and Melbourne, are falling. However, in these regular weekly commentaries, Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, has suggested that there are strong market fundamentals, and these are going to underpin our property markets. And over the last week or so, there's already been a lot of new updated data released, which is going to give us a clearer picture of what's ahead. So I look forward to this week's chat. Hi, Andrew.
Yeah, good day, Michael. It's continues to be deja vu, doesn't it? It's with regard to the outlook and the predictions for our housing markets. It's almost as though it's an irresistible urge from some, and surprisingly, some of our large corporations, and particularly the banks that have that exposure to the housing market. So, look, maybe they'll get it right this time for a change. Maybe
I hope they're not right this time, because they're suggesting we're going to have a 20-30% drop. But I also think that they're going to keep updating them like they so frequently do.
That's right. That's a movable target, isn't it? To be quite honest, Michael, it gets to the point where it's actually laughable.
Well, it's hard to make long-term decisions based on these sort of forecasts. But this week, a lot of data has come in, and one that's received a lot of publicity, of course, is the unemployment figures, which dipped to a new multi-decade low.
Another good result. It's an inarguably good result, Michael, and the fluctuations of underlying factors such as the participation rate and employment growth really can't hide the fact that this is one of our strongest labour markets, if not our strongest labour market on record, certainly in the modern era. And the modern era is about those monthly surveys for the unemployment rate. That's one of the few measures that we have that are on a monthly basis. The other ABS ones are still, I guess we could say, in the dark ages, giving us quarterly surveys of those really important macroeconomic indicators such as wages and inflation should be produced on a monthly basis, not a quarterly basis, particularly given the current circumstances. And that would, of course, match what happens in similar overseas economies. But we did see jobs fall over the month, Michael, and the participation rate fell as well. So that basically meant that there were fewer people looking for work. There was, ABS commented perhaps that this was due to the holiday period in July and some issues over COVID illness as well. And I think one of the other interesting points to the July results was that the number of unemployed is now lower than the number of job vacancies advertised. That means there's fewer people unemployed than there are actually vacant jobs.
Andrew, everybody's got a job, but people are looking for higher wages, considering that the cost of living has gone up. And the latest wages data just came in, but again, that's backward looking for the June quarter, but it suggested that wages only rose 2.6% over the last year, which means real wages are falling behind.
Yes, Michael, would have been somewhat of a disappointment to the Reserve Bank, who's been shouting from the rooftops that all its inside information is telling it that wages are rising strongly. Well, they're not. In fact, they're not moving at all. And the quarterly data for wages, for the wages index for both the private sector and the public sector, hasn't changed for the last 3 quarters. Private sector up by 0.7%, and the public sector up by 0.6%, which is basically the same as the previous 2 quarters. So no sign of a breakout in wages, as is being heralded for the last few months by the Reserve Bank. So no movement on wages yet. But again, as we've said, we really are looking backwards with that wages data, April, May and June, and weighted, I'm sure, with the surveys towards the April results. So we're probably yet to see the full impact on wages in this country from the very low unemployment rate and the shortage of labour. That'll work its way through the system. In fact, it's a really good thing to some degree, Michael, because it means that we're not getting the wages growth fueling inflation that we are seeing in similar overseas economies. Wages are rising much more strongly in New Zealand, the UK and the US. They have a different wage setting environment, different labour market. And that, of course, is fueling its way into inflation in those countries and into higher interest rates in those countries. Interesting, New Zealand increased its interest rate to 3% last week, Michael. So the Kiwis are having a little bit of trouble with inflation at the moment, and which is well ahead of Australia's. And their interest rates are amongst the highest in the advanced economies. So that wages data, yeah, look, not great news if you're looking for a big pay rise, around about the same as where it's been for the last decade. But probably some good news there in terms of maybe not having our interest rates as high as they have been predicted, and that means our inflation rate not as high as predicted, because we don't have the money to spend, the extra money to spend to keep pushing prices up. So a little bit of a good news, bad news, or bad news, good news story there for Australia. But let's remember that when we had our previous tightening cycle, the commencement of our previous tightening cycle for official rates back in 2011, where we were again seeing inflation rising through a strong economy, wages growth was just under 4%. So we are a long, long way away from that 4% growth that we had when we were increasing rates a decade ago.
All this is important when we look at the fundamentals of our property market. People have got jobs, their wages are going back a little bit, but at least they're going to be able to keep paying their mortgages unless interest rates get too high. And we know that the Reserve Bank for the third time in a row raised interest rates by 0.5% in August. But once a month, they also release the minutes of their meeting that give us some direction as to what's ahead for interest rates and their thinking behind what caused the last interest rate rise. While they gave us an indication of their thinking behind the last one, they're a little bit ambiguous about what's ahead, Andrew.
I think ambiguous is a kind reflection on their prognostications, Michael. I think they just really are just saying, well, it could be up, it could be down, it could be left, it could be right. Well, who knows? And that's basically the tone, I think, of their minutes was, we don't know. I mean, they were saying that at the one end, we might start to see an impact with higher rates on consumption. But then they said we also might not see an impact because there's plenty of offsets for consumers to absorb higher interest rates. And they're just saying, well, we're just going to sort of wait and see what happens and we'll let you know. Look, I'm being a little facetious, but seriously, it was the minutes did reflect a very high degree of uncertainty in the outlook. I think we'd be looking for a bit more strength in the narrative from the Reserve Bank. But I guess we are in uncertain times, and the RBA forecasts have certainly been characterised by being off the mark. And continue to be off the mark for some time.
Well, the Reserve Bank expects inflation to peak around 7%. It could even be 10%, they were saying. But they were saying we've got a resilient economy, we've got tight labour markets, and the market's suggesting that interest rates are going to peak probably early next year and nowhere near as high as had previously been expected. Putting all this together, a strong economy, strong employment, interest rates getting close to their peak, inflation peaking just ahead, that's all strong for our property markets. That doesn't suggest we're going to have those crashes that we started to talk about at the beginning of this chat.
Well, no, Michael, and certainly the signs are gradually emerging that the confidence factor perhaps is starting to ease in terms of the sentiment for buyers and sellers. The prospects going forward now into the spring selling season are certainly improving, and I think a lot of that has to do with the fact that the fundamentals of our property markets are very strong. It's inarguable that we are an undersupplied property market. Just look at where rents are going. There's no doubt that this will be a quieter spring than we've had in recent years, but of course, spring was that lockdown bounce back environment from COVID. So we were quiet and then we boomed. So it's a bit more normality now. But of course, we are an environment where affordability has declined through high prices and now higher interest rates. So of course, we've got to build back up again.
Well, having said that, Andrew, the auction markets over the weekend again showed the strength because despite listings surging, particularly in Melbourne, clearance rates held up pretty well, didn't they?
Yeah, that's right, Michael. And there was a big jump in listings and in Melbourne, and listing numbers rose everywhere, with the exception of Adelaide, which was basically flat. So listing numbers are holding up. But again, as we state every week, listing numbers tell us what vendors were thinking 6 weeks ago. And of course, we were pretty gloomy 6 weeks ago with interest rate rises and a lot of bits and pieces. But there's no doubt that clearance rates are holding. Another 60% result in Melbourne and Sydney. If we move back before all the roller coaster stuff of recent years, 60% was a pretty fair result in a winter market. The numbers are around about what we would expect in the winter environment. And I think that it's, again, that interesting occurrence that the markets that have gone down first and sharpest, Melbourne and Sydney, are now coming back, whereas the markets that were holding up, Adelaide and Brisbane and Canberra, particularly Brisbane and Canberra, are now coming back, right? So it's their turn for the weaker environment to some degree, whereas Melbourne and Sydney are looking like they might have troughed. There are other signs that are validating the fact that the Sydney market particularly is now reaching for the bottom. I'm not saying we're not going to continue to see weaker housing market conditions, but I think that perhaps we can start to speculate that the worst is behind us in terms of falling prices. We may get a reasonable spring selling season ahead, Michael, particularly in Melbourne and Sydney. And mentioning Melbourne really hasn't, it's been the great survivor to a large degree, given how high its prices did rise and how strong its markets were. Yes, it's certainly tracked backwards, but it's eased rather than fallen, and it continues to really look to be the most resilient market, with the exception perhaps of Adelaide.
One of the problems the forecasters are having is that they're taking the monthly fall in property values, annualising and saying, see, property values are going to drop 20% this year. It doesn't work that way, does it?
No, and of course, this is what we'll get back to. It'll be all these convoluted measurement processes, say, well, according to our measurement, blah, blah, blah. But as we keep reminding people, Michael, the worst national decline in house prices over a calendar year, and let's be clear, this is ABS data, and we're measuring the December quarter to the December quarter as being the annual change, because that gives us a robust measure of house prices, because monthly house prices can be quite volatile. As I said, the worst result there nationally was 5.5%. So it's like, wow, that's a long way short of 20-30%. Again, when we've got to look at the fine detail with these forecasts, Michael. So what are we talking about here? The national house price. And of course, can somebody please point me to the national house? Where is it? Because these measures are an amalgamation of the capital cities typically, and that was what I was talking about before. That was a capital city national house price, and they're based on, weighted averages, which do reflect the sales volumes. And of course, that means that it's always skewed towards Melbourne and Sydney results because they have the most number of sales. So even if we get a decline in house prices over a year, it's likely to reflect what's happening in Sydney or Melbourne, right? And we can have positive growth in other capital cities. And I think that's what we're going to see this year, Michael. We'll certainly see prices lower over the year in Melbourne and Sydney, but I think we're going to continue to see, we will see annual prices higher over the year in Adelaide, Brisbane and Perth.
Well, we've got the spring selling season ahead of us. I look forward to a chat when we talk about what's ahead for the spring selling season when we catch up real soon in the next Property Insider chat, Andrew.
Yeah, thanks, Michael.